And we're live. And we're here. Gosh, it's been weeks. I feel like I had a hard time setting this get up.
I put a lot of miles behind a steering wheel since I've been here. And so it's, I've missed everybody. Hi there. It's been a good last couple of weeks, but it's also great to be here with all of you guys this morning as you look over the for your safety disclaimers. I can't think of any new disclaimers that I've seen in my life that we need to add to this, but I am having a meeting with Donna, our third-party compliance consultant this afternoon, and maybe she'll have a new one that we need to put out there.
Don't know if some of these are even relevant, but
yeah,
we're just covering our behinds on any way we can.
Well, and shout out to all of Gimbal Financial's business helper associates. We have a behind the scenes team that is just fantastic. And many of these people are on the East Coast or the West Coast or somewhere in between. It's technology, it's people, but at the end of the day, it's just individuals looking out for your backs and our backs, and grateful for them.
We appreciate that.
Yeah. Yeah. Is that enough disclaimer talk?
I think that's enough. We'll stop sharing that, and I'm going to close this out. Greetings from Fishers, Keith.
Well, it's good to see you guys.
Likewise. You know, actually, one of you guys did reach out and say, are you guys having your webinars again? And I really appreciated that, because I don't know if anyone watched.
Yeah, and you know, I think the point of these things are basically, well, there are a few things, but number one, we want to empower you. We want you to know what you're invested in, and we want you to feel really good about what you own and how you own it. We want to educate along the way of new ideas or things that are happening, changes in the investment landscape or tax or estate planning landscapes. And then, quite frankly, I think the most excellent thing this does for me personally is it helps me stay on my game and encourages me to keep learning.
Yeah.
And so thanks for tuning in and learning alongside of us. So should we kick off about markets and then we can get into other things? Is that cool, Keith?
That sounds like a plan. And let's see here.
Keith and I were on the same wavelength a couple minutes ago. We were just laughing that one of us is not needed, because we were thinking along the same line about a certain market statistic gatherer. And I'm looking forward to sharing that with you. But it's been just I would say, a sloppy stock market. It has been hard to find traction almost anywhere, unless you are invested in commodity related things, which even those have been kind of tough in the last week. But yeah, the overall stock market, like the S&P 500 and the NASDAQ, you know, those are just made up of individual companies, and we're in earnings season right now. And so those earnings have been pretty choppy. Whereas for the past several years, it just seems like, you know, 70–80% of all companies reporting have cleared their hurdles.
Can you see the screen?
Nope.
I see a blue screen with a folder in the middle of it.
We see your desktop.
Let me try sharing again then. Let's try this. How's that look?
That looks better. That looks like a Google Doc.
This is just a metric that I started 6 months ago or so, and just it's the total number of stocks in our database that we use, and it gives you a feel for those that are trading below their 21-day moving average, their 50-day moving average, and their 200-day moving average. And where I've put the kind of, I don't know what color you call this, Amanda, orange or whatever. Yep. That's the highest. That's the place during time where that's been the highest level. So back in the end of January, the highest percentage of the stocks were below their 21 and 50-day moving average, and then a few weeks later is the 200-day moving average. And what we've seen since a little bit of a rally at the end of March, we've seen these things move back towards their those high levels. And so if we go and look at the market, then is that showing Market Smith for you guys?
Yes.
It let's see here. I'll show you the S&P 500. We were talking about, I think, as far back as the summer, that the market sure had a lot of challenges under the water level, and you had a little bit of a dip in the September-October frame, and then you hit a new high. And now we're below this black line, which is the 200-day moving average. And so we'd love to get more aggressive in the markets. I think we'd love to see the S&P get back over that 200-day moving average. And it's kind of in a downward slope right now. And so it's going to take some time, I think, for some of these things to heal. The last, would you say, 5 years, the FANG stocks have driven the market, Doug?
Yeah, I think so. There's FANG stocks, Facebook, Amazon, Apple, Netflix, Google. There's been some others, but those have definitely been large drivers. And if you have a retirement account and you own something like the S&P 500, you've owned some of those names, and they have been large percentage holders of your investments, and they've done well. But like Keith was talking about, when investments like the S&P index here, when it gets below the black line, that's the 200-day. When it gets below the 200-day moving average, that's normally a tougher current to swim against. And so we talk about the 200-day average a lot here. We like to see prices above that. And I think in order to get back there, we're just going to have to see new leadership emerge. Whereas the commodities or maybe the energy stocks have been doing decently well this year, the technology, the FANG stocks have really been beaten up pretty good.
And if you look at the just the slope of the 200-day moving average on this, it's what kind of world-class investor Mark Minervini calls an easy dollar kind of environment. And I would say that sometime right in maybe here, when we started coming down towards the 200-day moving average, we moved into what he'd say is a hard penny, where all along here you can make dollars pretty easily, but as things start to get more choppy in the market, it's hard to even make a penny out there. And that's why I believe if you're looking at your statements, that's why we've got a good amount of cash on the sidelines, is because the risk in this kind of a choppy market compared to the potential upside is pretty minimal in our views.
Yeah, we'd like to see even the red line, not the one that Keith just drew, but the red line that kind of follows the stock prices along. We'd like to see that start to point north before we got too excited. And
which one is that? As a refresher, the red.
Oh, I'm sorry. That's the 50-day.
Okay.
So thank you, Amanda. Those are the prices in the last 50 days. And so, we'll probably take a look at a couple other indices here in a minute, but overall, the prices have just fallen below where they've been. And that tells us it's a good time to be a little more conservative. Trend following is an interesting term, and you see it in your lives, whether that be going to a restaurant. If you're having a good experience, you go to Chick-fil-A, you've probably got a good experience every time, no matter if the drive-through line is out the parking lot or whatever it is. The trend is it tells you, hey, people like to eat here. People keep coming back here. I keep going back. They make it easier on an app, on a phone. So they're moving in the right direction. There's so many examples of trends in your own life, whether that could be love and relationships and all kinds of things. But the same is true in stocks. We like to see things moving forward and then jump on board as they're going forward. And conversely, if they're heading the other way, we'd just rather sit out that dance.
Yeah, and if you look at the black line again, the 200-day moving average, what it looks to be doing is it's flattened out, but just from me looking at it there, it actually looks like it's a little bit lower than it was a week ago. And you don't really want to see the kind of the averages over the last 2 year trending downwards. It's not usually the easiest market. However, there will be some opportunities here before long to do well. But with regard to the FANG stocks, they probably, I don't remember, Doug, was it like 30 to 40% of the index? Is that what they represented? Something that might have been the NASDAQ.
Just through growth. I mean,
yeah.
their growth expanded and swallowed up much of the index. And so that is having a negative effect right now.
Yeah, if you I'd like to be able to show you some charts. However, the regulatory people think that you guys wouldn't be able to handle it and you would go out and buy these things or sell them because we were just showing you something. But if you were to go out and look at the FANG stocks independent of us, you'll see that they've had some significant damage done to their stock price in the last 90 days. And we saw this process has gone on as long as there's been stocks. In the 70s, it was called the Nifty 50. And now it's the FANG stocks. And I think almost every one of them has had major damage to the structure and the price of the stock. And
I cut in half.
Yeah. And so those, there's an old saying, fallen angels don't get back to heaven anytime soon kind of thing. And those stocks, they're not, in my opinion, going to be reaching back to new highs in the next year or two. If we were to talk about Microsoft, when it peaked out in 2000, I think it was 16 years before it got back to the level it was in 2000. So we definitely aren't a fan of buying low just because something's low. If it's a valuable asset, then we'll look at that. But that's what's going on with the S&P. And I think because the weighting, WEIGHTING weighting of the FANG stocks in the NASDAQ, you can see a much more angry look at this chart. It is significantly further below the 200-day moving average. Oops. Track price. It is.
Go ahead and share that, Keith, if you can.
Oh, I'm sorry. I'm just sharing it with myself here. Is that it? You got it?
That's it.
Yeah.
So it is right now 13% below the 200-day moving average, which is right here, which is a considerable level lower than the high over here.
I think that's an important thing. Just even like you think about that, Keith, and it's 13% below the black line, the 200-day, and just what is your threshold of pain, just as an investor to know that. And if your account was down 13%, you know, what type of emotions trigger at this point for you in your life today. And so that's just another conversation to be having with your investment advisor, with yourself, to know your threshold of pain, and then to know, like, what game are you wanting to play? Are you wanting to play the NASDAQ? Are you wanting to play dividend stocks? What are you looking for?
I don't recall when we started moving out of the NASDAQ last year, Doug. Do you remember? But the bulk
around November, maybe October, November.
Yeah, the bulk of the NASDAQ holdings in our clients' accounts, we moved those out a long time ago. We still, because the S&P and the NASDAQ have similar companies in it, we still have some of those NASDAQ stocks. But this is from 16,000 to 12.5. That's a 20 some odd % drop from the high. Sometimes in investing, defense is just as important as offense, I think.
Yeah, it's easy to get the deer in the headlights look and just say, oh, I hope this all works out because it's worked out in the past. And we're optimists over here. We think the stock market has legs to run, but there's just times during it when it's just better to pause for a minute, be patient, because we don't know what type of market we could go in. Keith mentioned, Microsoft moved sideways for a long time, and these indexes can do that too. They can move sideways for a long time, and it might just be better for a risk reward standpoint to look at different opportunities.
And I think it's noticeable on this chart, Doug and Amanda, that the 200-day moving average is actually turning downward on this one.
Yeah, noticeable.
Yeah.
And part of the good news on that is it turns downward, it makes it easier to get above it.
That's so true.
Yeah.
Do you want to flip to the Association of American Individual Investors?
Yeah, hang on one second. There was one other.
Optimism.
It's
been a bit of a downer of an episode so far, so that's really
actually,
lovely.
Yeah, that's a good word.
Yeah.
It'll be interesting. There's so many areas in the marketplace today that I look for that long-term average to start to trend down. And if you're thinking about buying a car, you might be battling that thought. Will these prices ever adjust, especially in the used car market? Maybe new car might be is what it is, but the used car market. Okay, yeah. Here's what I was wanting to take a look at. Keith is posting a tweet from the American Association of Individuals Investors, and they put out this sentiment survey. This is how you feeling, and they put out the how you feeling question to their association members. We're one of them. I don't vote every week, but most weeks I do. And if you can take a look down below, Keith, did you want to add to that before we go into the results?
Well, I don't want to hurt any individual investors' feelings out there, but it tends to be an inverse indicator. It says that the individual investors are always wrong, is what this particular one says. And so that's probably the initial thing. And I'll try to see if I can blow this up for you.
So when you look down at the results, you can see the pessimism. And again, this is if we could forecast, hey, where is the stock market going to be 6 months from now? What do you think? Is it going to be higher? Is it going to be lower? Are you neutral? Do you not have an opinion? And where we are right now, I can't see those numbers. I need my binoculars, not my glasses. But is that 16%? Is that right?
That's optimistic.
Yeah. What's it?
Let me see if I can get a better.
I think
that's about right.
I think that's about right. And the pessimist, what are they? And it's about 50, right?
It's close to 60, I think.
Yeah, and I think I from what I read earlier this week, the pessimist right now, it's the highest it's been in a year. And normally, like on average, it's pretty much split in thirds, a third.
It's actually higher than that, Doug.
A little bit.
It's the highest level of pessimism since March of 2009.
Oh, okay. And so to Keith's point, this might be a reverse leader, like whatever they're thinking, do the opposite. and so what does that mean? Here you heard us talking about how we're kind of down on the market and we're edging towards being out or having more in cash. So are we confusing you yet? Basically, what this means is during times like this, when the market's trending down, we're shopping. We are creating a shopping list. We're creating a dream list of, hey, these are the types of things that we would like to see happen. And Keith, he even gets so analytical. He puts prices on there. He's like, not only is this what I'm looking for, but I want it at this price. And so we're going to allow the market to tell us, when it's time, but we're looking for opportunities that might be great investments over the next 6 months. And so with that bullish bearish indicator, I got pretty excited when I saw that this week. It doesn't mean we're out of the woods, but it does tell me, hey, there's a lot of fearful people out there. And I can't remember which famous investor, you probably know, guys. What is it? Be fearful when others are greedy, and greedy when others are fearful. And so it's time to, you don't have to be like totally Pollyannish, but to look and say, hey, what's the opportunity ahead in the next 6 months? And my guess is we're going to see that, and we want to be ready for it.
And I think it's fair to say in a bear market is a market that's trending downward. I would say it's fair to say we're in a bear market. Bear markets tend to absorb good news and drop farther on bad news. When I say absorb, they don't really go up on good news. A bull market will go up on good news and absorb all the bad news. And so with the NASDAQ 200-day moving average turning down, that's 200 days is about a year. That's saying that we've been trending downwards now for about a year. And so the idea that we're at a low on most of these indices for the last 12 months, we could have some bear market rallies that are pretty traumatic. One of the things I was reading this morning is when the AAII index is so bearish that you could just almost have a catapult upwards on it for a few days. And that in and of itself doesn't mean we've switched out of a bear market. It just means that, the markets get really volatile when you're in a bear market. And at some point, all the people get tired of selling and it settles down and isn't as volatile. And so that's kind of what we're trying to, if you go to the beach and they have the black flag out, that's kind of how the market is. If you want to buy something, it may be a good time to buy, but you might wait and see what color flag they have out tomorrow.
Yeah, I was thinking of a fishing analogy. My sons fish. I don't fish, but my sons do. And they tell me that tight lines are better than loose lines. And so, right now our stock market has really loose lines where the prices are doing this just all day long. But when you get a tight line and things are, day after day, the price isn't moving as much. Might have a fish on. That's when we would rather cast some bait out there. Hey, Keith, we are near the end, and you probably have some other things you want to talk about. I know I had a list. Amanda's probably got a list, but I've got to know, guys. I mean, I think since I've been on spring break, I was on spring break and I tried not to look at the stock market, but I just kind of can't help myself. And I saw where the maker of an electric car company was thinking about buying a social media platform, and the price started to get real wiggly and all this stuff. And I just can't believe that's happening. Keith and I have been talking about how back in the early days of capitalism in America, there was a lot of fighting. There's a great documentary on the History Channel if you want to look for it. It's like, oh gosh, the name just escaped me. But basically, these are the Rockefellers. They're going after each other and they're creating new things, and they're not friends. And I've just really enjoyed the battle for investment survival, or the battle for business over the last couple of weeks. I don't know if you guys have enjoyed seeing that in the news or not, but I think it's been great.
Yeah.
One of my classes in graduate school was studying the history of all this, and I just I'm not an aggressive personality for which I would want to step on somebody else's head and crush their career to make my career better. But those guys in the 1800s and early 1900s, it was an aggressive, cutthroat situation. And with Bill Gates selling shares of Tesla short, he's basically sending out a war signal to Elon Musk. And so it's hard to know how those things will unfold. Human nature is pretty much the same. People's egos get in the way and they can't think clearly. And so I think it's just a really interesting time to be alive.
Yeah, it is a great time to be alive. It's a fascinating time to be an observer of the stock market and a participant. And we get to choose if we want to hitch our dollars to any of these companies. I mean, you've got a choice to do it. And even in the indexes, you've got a choice there, which ones you want to be heavy and which ones you don't. So anyway, I think this week's been pretty fascinating in that department. I don't remember a time where this has happened in my investment career.
Do you know what year that AAI index started?
It's been a long time. I don't. I'll look that up for next week.
Yeah, because I was going to show you this chart is the most.
Oh, what year? Amanda's on the Google.
1978. Okay.
I was going to go to some card catalog and look that up, but apparently Amanda knows how to do that a lot quicker.
Can you guys see this chart?
Yep.
Yeah.
Yeah. So this chart is one of the more meaningful ones. To me, this is the index of the M2 money supply. That's the amount of actual money floating around our economy. And you can see right across this line here, this is about the growth of it over time. And you know, with 2008, with what the government did, I thought was crazy, and they increased it, but they brought it back down. The Federal Reserve did, and then they raised it back up in 2012 here, but not, I think that's 1960. There's never been an increase in the M2 supply at the level that's gone on here. And what that means is there is a lot more money chasing a lot fewer goods and services. And so the inflation, we've been talking about that for a lot of weeks, but this shows the reality of what's going on out there. So the longer you keep money sitting idly, the more difficult it is on the purchasing power of your money. So even as we are sitting heavier in cash, we don't want to be there very long, but that's kind of the thought process that I think we're working through. We realize the inflation's out there. We realize there's a lot of possibilities where we can put the money, and there's just not been a lot of good situations to jump in right now.
And sitting in cash used to make me anxious. It did, because I was taught, hey, have your money invested, let it work for you, hang in there, and hope for better days. But over the years of just learning and educating and studying the graphs like we have today, it puts data to the why. And then it also puts data to the point that there will be better days ahead. And we'll see it. And the market will tell us. And so that's the journey that we're on, and we're glad that you're on it with us.
That's a great final words, I think.
I got one more final word. This one includes a chart here. So I don't know if any of you have been mushroom hunting before, but I never knew you needed to have shells to do it. But the bullets were just along the side of my morale there. But as I was out with a client doing some mushroom hunting this week, I was just thinking about the thought process that goes on with mushroom hunting. I don't know if any of y'all have done that before, but
I've done it.
Yeah, it is a lot of time setting your mind and your eyes looking for something that you may not even see. And what I was thinking about as I was doing that is I had a client telling me that she had been watching a lot of news and you know, she's very pessimistic and things. And she ended up spending a good amount of the month of March in medical exams to find out she had just kind of worked herself up and caused those things. And I would say that if you could search for the blessings in your life, like hunting for a mushroom, and search those out and focus on those rather than the weeds and all the underbrush and things in life, I think you're going to find your life to be more enjoyable and more encouraging. And if you can just turn down the noise on TVs and things like that, I think all of this will work out much better for not only you, but me and everybody else.
Man,
That doesn't
keep this the
really-
Mr. Rogers of Gimbal Finance. I mean, that's just a good word
Yeah,
right
that's a good
there.
one to end on.
Man,
Both were great.
that was solid.
Well, thanks so much.
Hey, have a
I'll
great
see
weekend,
you
everybody,
later.
and enjoy the hunt.
See ya.